So Rick, as I mentioned, is the Chief Investment Officer here at RFG Advisory. In that role, he's responsible for managing our client assets and investing our client portfolios. And he's got a really interesting background. He has a lot of institutional experience, and it really it started here in Birmingham, Alabama, which is where we are headquartered, where RFG is headquartered, where he grew up, and then went on to Harvard University, where he graduated magna cum laude and joined Bain Capital when they were just a brand new startup firm. And yes, that is Mitt Romney's firm, is how it is most famously known. Bain went on to send him to Stanford, where he was number one in his class and awarded the Henry Ford Scholar. Do you feel good about yourself yet?
This is the best morning ever. This is fantastic.
So he was number one in his MBA class at Stanford University, returned back to Bain Capital, where he spent 12 years in total. And when he left there, was responsible for an $8.5 billion investment portfolio. So he has seen a lot in the investing world. He's weathered multiple markets, and it's fun with someone who has that level of experience and that lens to really be talking about what some people still consider a relatively new area of investing, and that is ESG. It is a question that we get asked about a lot, and we really felt that it warranted a special session where we could just dig in and give ourselves some time to talk about what is ESG, what does it mean for investing, how can you incorporate it into your portfolio if it feels like something that's really aligned with your investment strategy, your risk tolerance, and ultimately with your values. So let's just jump right in. The most obvious first question I've got to ask is, we love our acronyms in the financial world. What does ESG mean?
Okay, so ESG, first and foremost, thank you for the introduction. It does make me feel great in the mornings. ESG stands for environmental, social, and governance. And that kind of speaks to what I'll try and put in layman's terms. We call it investing your values, right? So you're interested in building a portfolio. You're interested in thinking about, how do I manage money for my retirement? How do I save? How do I build a financial legacy? But you start to sit back and think to yourself, like, geez, and not to pick on anybody, but geez, I don't want to invest in tobacco companies because I feel like their product is something that I don't support morally. I may have a value problem with, right? Or, not to pick on another company, but, I don't want to invest in big oil companies or petrochemical companies because I'm worried about pollution. There are other types of companies where you may say governance is one where you feel like the way in which the company is run is not reflective of your values in terms of, what the voting shares look like for various classes of equity. And so ESG was really coined as a term or as an acronym to really try and reflect that style of investing, right? Where it's, okay, look, I want to invest, but I want to invest broadly and find the best companies, but best company doesn't just mean what we normally think it means in the context of, financial planning and all of that kind of fun stuff. It also means, investing your values and staying away from companies that you might find problematic.
I mean, it's really interesting at this moment in history in particular, where I feel like there is overall a heightened consciousness around what are the environmental implications, what are the diversity and inclusion implications, like how companies if you look back, there was not this focus on corporate responsibility.
I agree.
And I feel like in some ways, that ESG is reflective of that. While it predated to some degree what's happened over the course of the last 12 to 18 months, it really is like there is a syncing up that is happening where you're able to invest in an ESG portfolio at the same time that corporations are starting to talk about in the boardroom their environmental impact, their diversity inclusion, their social, their governance. Like there is like it's just an interesting time that there is an investment strategy that you can align with your values at the same time that this is becoming more important.
Well, and I think, look, if you were to rewind the tape on our industry probably 20 years ago, everything is bottom line focused, right? Like what was your percentage return relative to your benchmark, full stop, nobody cares about anything else. And really, I think within the past 5 or 10 years, there's been on the institutional side more desire to kind of release these products to people in ESG in particular that allow them to kind of craft an investment portfolio that enables them to meet these goals, right?
Yeah.
So 20 years ago, 30 years ago, you could always look at yourself and be like, oh, I don't want to invest in big tobacco. But the only way to express that in an investment portfolio was to build it yourself, right? Like there was nobody that was going to advise you on that portfolio or build one for you. You were going to have to go out and do the research, which for most people is just too much of a lift, right? Like I want to build a financial legacy. I know I don't want to leave some sort of, dastardly social legacy. And so I really, but I don't want to spend, months and months and months researching every stock and thinking about this and that and the other and putting together a portfolio. And that's what I think has really been impressive over the past 5 years, really, is this recognition that there is demand for this out there, that it is something that people want, and the recognition by institutions that, okay, look, we should be able to craft these portfolios for people so that they can say, yes, I'm concerned about this. I still want to build my financial legacy. Let me put all that together in a product that people can invest in.
That's like a perfect setup for, the next question, which is really like, how does ESG work?
How does ESG work? Well, there are a lot of different flavors of ESG, and I just want to be very clear on that. Like the term ESG is used broadly to describe investing your values, right? Broadly to describe investing your values, okay? So on one end of the spectrum of that, we have people that only want to invest in companies that are actively working on social causes in addition to profits, right? So like these are the company, the stereotypical one, or the one that jumps to mind is like, this is the company that is building like well drilling equipment for communities in Africa, right? Or this is the company that is doing like hydroelectric solar power, like this and that and the other. And I'm only investing in these companies that are for profit, but are trying to change the world in a positive way, right? And that, not surprisingly, winds up with a relatively narrow list of companies that are out there, okay?
Right. And I would say a narrow list, and also that there's a lot of risk there. And
yes.
If you're forging new industries,
yes.
there's some risk there.
Yes, and I would also, not only in forging new industries, these are generally new companies, but they tend to be concentrated around a lot of sort of narrow product scope, right? So you don't get anything in the chemical industry, right? Like you don't get anything in a couple of these other industries, so anyway, that is what it is. On the other end of the spectrum, you have what I'll call more let's avoid the bad actors style of investing, which is I'm going to pursue a broad swath of the investment universe, okay? And I'm specifically going to try and exclude from the portfolio anyone who is, just on the more offensive side of my value spectrum, right? So this is the folks that are like, I'll own everything in the S&P 500, but I don't want to own tobacco companies. So give me the S&P 500 except for tobacco, right? And that style of investing tends to be a much more diverse pool. It's candidly the style that we use in Steadfast. And it tends to be a more broad universe with which to pursue sort of building that second goal, which is building a financial legacy.
So, all right, we've got these two barbells. You referenced,
and just so we're clear, we got they're barbells on the spectrum, but we got everything in between, right? Like we got two barbells on the spectrum, but everything on that.
And you mentioned, you tend to in building steadfast ESG tend to focus on this end of the barbell. So let's get into it a little bit on the investing. Like, first off, I want to talk about, in that barbell approach, active versus passive investing.
Mm-hmm.
What is it? And then how does that apply to ESG? And then, like, is there a catch? Am I giving, is this too good to be true? Like, can I invest my values, or am I, really being, hoodwinked?
No, absolutely. And let's start, there's a lot to unpack in that question. So first, let's start on the active versus passive debate and just kind of define what active versus passive means, okay? So active investing is when, the manager of traditionally mutual funds, or maybe even, a third-party managed account or whatever else, but there's an active manager, normally with a team of research people along with them, that are picking the stocks that go into a portfolio, right? So these are people that are, they're building the research models, they're listening to the earnings calls, they are doing all of the work to be like, okay, I want to own Delta and I don't want to own United, right? Like, I'm making that decision, right? And that's what they get paid to do, right? And they generally get paid fairly well to do this, right? If you think about it, they're all accomplished professionals, and you generally have a lot of them running around the fund. And so most actively managed mutual funds charge anywhere from 50 to 100 basis points, so 0.5 to 1%, to manage that money for you, right? So, basically they are the ones picking the stocks. They take that expense ratio out of the, returns, and then they give you what's left, okay? On the other side of the spectrum is the passive. And when I hear people talk about, like, Vanguard, these are the champions of, like, the passive investment style, which is, hey, guess what? It's really hard to consistently generate alpha as an investment manager, right? And the argument sort of goes something like this, okay? There's 500 stocks in the S&P 500, and somewhere on the order of magnitude of 3,000 different large cap fund managers that are all trying to pursue alpha within those same 500 stocks, right? And so at some point, since in every trade in the marketplace, there's a buyer and a seller, right? Like, every time one person sells and thinks it's a good idea to be selling, there's somebody on the other side of that trade who's usually equally as smart saying, no, now's the time that we should be buying. It's just a very competitive marketplace to try and eke out any type of, any type of consistent long-term alpha, right? And so the thought process goes, well, if that's the case, then why don't I just own an index? Like, I'm just going to broadly construct an index, like using an Excel spreadsheet or something else like that. And I don't need to pay for the fund manager and the research assistants and everything else like that. And so the way that I'm going to compete with those active guys is, yeah, I'm not necessarily actively picking the funds, but I'm not subtracting, 0.75% out of returns every year to pay for all the people that are doing the picking. Okay. So passive, very formulaic based, like, it's an S&P 500 index fund, or maybe it's another index fund that's tracking various factors, but it's all numeric, right? There's thought behind the construction of the algorithm, but there's no thought that goes into whether or not I own Delta or United, right? Active, other side of that, you've got somebody that's like, nope, this is the right, they've got the right aircraft fleet, or they don't have this, or blah, 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 blah. And I'm making an active call, okay? Within ESG, these distinctions exist as well, right? So once again, to come back to our barbells, right? Yeah. The active managers are the ones that are out there saying, like, okay, well, this solar company is, super fantastic and bringing electricity, and its form factor is small enough to be able to go into these rural communities, or its development cost is lower, or whatever it might be. And so they're making the active research call around, like, hey, you want to own the following 15 companies or 20 companies or whatever it might be, right? On the passive side, what they're basically doing is they are scoring companies using primarily third-party research services on a wide variety of things, such as, social impact, environmental impact, this and that and the other. And they're just like, they take these scores. There are services that score the companies and basically say like, yep, you get an A+ on the governance side and you get a C- on the environmental side. And, that blends to a score of this. And I'm going to put together a passive index that weights these companies based on their scores on ESG issues, right? And then it's not, they're much lower cost than an actively managed fund. They tend to be much more broadly diversified than an actively managed fund. But they are relying on these scoring issues to be like, okay, this one does well over here, maybe not so well over here. So I'm going to own a little bit less of it than I would if it had a better score, say.
I love that. Framing it up as a report card was so helpful to understand, like, how can you gain access to the asset class? You have the opportunity in ESG to, go with a manager that's really focused on this individual selection of the companies, or the report card approach.
Yep.
So overlay mathematically scoring broadly across the index. So you're basically dumping all those companies that have a bad grade.
Yeah. Yep.
Sending them to the principal's office.
It's
and you're investing in the ones that are, the valedictorians.
Well, and academics is near and dear to my heart. And, I'm thinking about who's invited to take the PSAT or like this and that and the other. But yeah, it's basically like, for an actively managed fund, if we were to turn it into a student selection, this is the college admissions that interviews every student that they then choose whether or not to select. Whereas the passively managed are more like, oh, your GPA is over this and your SAT score is over that, you're in. That's the way that works.
All right. So, most people, as they're thinking about their portfolio, or their financial advisors thinking about the construction of their portfolio, aren't just fully tilted to equities. They're also interested in what is the yield on my portfolio, or maybe some are predominantly focused on income generation and what is the yield in the portfolio. At the beginning of this, you talked about throwing out the, what they would hate to be called this, but, the bad actors from an ESG perspective are a lot of the companies that would show up if you were screening for yield. So you're getting rid of oil companies. You're getting rid of, some of these industries that you would traditionally go into. So how do you thread that needle? How do you invest in ESG, invest your values, but also generate yield?
Okay. So it is true that a lot of what I think are typically viewed as problematic sectors from an ESG perspective tend to be older line companies, more value-oriented companies, value in the investment style, that have higher dividend yields, right? So tobacco, oil, all of these companies, they generate a lot of cash flow and they tend to distribute that cash flow out to their constituents. And so you're correct. From a yield perspective, it can be harder to source more yield in ESG than not. However, the thing is that, I would honestly look at any client that came to me and said, hey, you know what? I'm really interested in income. I want income out of my portfolio. The question is really, okay, well, how are we going to source? I know that you want to take cash out of your portfolio, right? Like that's what every retiree wants to do. Like newsflash, it's not a new thing, right? Like everybody wants cash out of their portfolio. And there's this old school line of thought that was really like my grandparents' generation, if I'm honest, that was like, you know what? Like I accumulate all of this wealth. And then I bought these bonds and I bought these stocks and they're paying, a 6% yield or an 8% yield or whatever it is. And so the way that I'm going to make sure that I never run out of money is I'm just going to spend the interest and dividend income and I'm never going to touch the principal, right? Like, and I've basically kind of almost in a way created like a little annuity for myself of like, I know that income stream is always going to be there. And here's the problem with that. It worked back when interest rates were like 8 to 10, 11%, right? Like then it works. In the current interest rate environment, when the 10-year Treasury is at 1.6 and the S&P 500's got a 2% dividend yield, that math just doesn't work, right? Like unless you are living well below your means, okay?
Yep.
And when we try and create a portfolio that's got like a 4% yield or a 5% yield on it, it's possible to do. However, you wind up pushing yourselves into these odd concentrations of holdings that are not really beneficial from an overall portfolio construction standpoint, right? Like we like broad diversification. And if you're only targeting the areas of the market where you can get a 4 or 5% yield, it's a very narrow slice of the market. So you're not going to own any technology. You're not going to own any healthcare. You're not going to own any of these other sectors, which broadly speaking is great for the sort of sleep at night, like, oh, okay, like I'm never spending, any of my principal, but bad from the perspective that like at the end of the day, you're left with a portfolio that's almost 100% oil and real estate, right? Like, and that's just not good sector concentration at the end of the day. So what we encourage people to do is say like, look, there are 4 sources of income that you can generate out of a portfolio: interest income, dividend income, capital appreciation, and in certain cases, principal drawdown. And at different times during different parts of the market cycle, depending on where you are, we want to draw capital from all 4, right? Mm-hmm. We want to spend all 4. So I would look at you and say, okay, look, yes, I might get a little bit less yield out of an ESG portfolio than I might get out of a non-ESG portfolio. But the real question we should be asking ourselves is there a difference in the long-term returns of an ESG portfolio versus a non? Because if they've got the same return, it shouldn't really matter to you whether or not it's coming to you as dividend and interest income versus coming to you in capital appreciation. And by the way, if it comes to you in capital appreciation, there's probably a tax advantage.
Which is a perfect, segue on returns. Like, have ESG portfolios, you talked about this has really become a focus for the market over the last 5 years. Have they tended to outperform? Have they tended to underperform? Are they performing in line with non-ESG? Like, where are we on the numbers?
Yeah. So the good news is the jury's still a little bit out on this. But if you think back to what we were just talking about, where there's a little bit of a stylistic difference, right, between ESG portfolios versus non-ESG portfolios, it kind of comes down to growth versus value, right? So ESG portfolios are going to be overweight companies that are a little bit more techy, a little bit more growthy, a little bit more, you get more of the Netflixes of the world and more of the Amazons and Googles of the world and less of the Chevrons and BPs and all of those types of things, right? And so it does wind up with a little bit of a tilt in one stylistic direction. Theoretically, right? If I put on my pure academic hat, I could make 2 arguments here. The first argument would go somewhere along the lines of, okay, look, when you invest in ESG, you are cutting out a certain portion of the market. Yeah. You are denying capital to a certain portion of the market. And that portion of the market will thus become cheap relative to all the rest of the market. And assuming that, eventually people conclude that ESG is wrong, then you will have missed out on the cheap part of the market, right? That, Philip Morris is underpriced because they sell tobacco. And so if you don't have a moral issue with Philip Morris, then you should go buy Philip Morris because you're going to get it at a discount, right? So that's argument 1, okay? Which is, by the way, I've heard that from several academics, right? Like, I'm not just making this up. Like, I've heard that on the academic side. Argument 2 is, okay, but the companies that are in these sin industries tend to face increased regulation, right? So, maybe it's restrictions on whether or not you can sell vapes. Maybe it's increased environmental restrictions on carbon emissions. Maybe it's, trying to crank down on drilling or trying to crank down on this, that, or the other. And that over time, those increased regulations are detrimental to those companies' bottom lines in ways that other areas of the market don't face, right? Because the government isn't interested in regulating their business activity. And so there's a little bit of a yin and the yang here around like, okay, well, on the one hand, yeah, I'm denying capital is something, and maybe that means it's a little bit undervalued. On the other hand, if the government is about to come around and start to restrict the way in which you can advertise cigarettes or where you can sell them or who you can sell them to or this and that and the other, maybe that's bad for these companies on a longer term, right? Like if there's
so they're undervalued for a reason.
So they're undervalued for a reason, right? And so what I will tell you, what we know from the data, 5 years, 5-6 years in which these funds have sort of become mainstream is not enough time to demonstratively demonstrate whether or not one is better than the other. In the past 5-6 years, actually the ESG stuff has performed better, but then again, growth has performed a lot better than value over that time frame. So the jury's still out. There is no conclusive argument, but if you're worried that to be like, oh, well, I'm going to invest my values, but I just feel like I'm going to be giving up a massive amount of return, I would tell you that those fears are probably unfounded.
It was interesting listening to you talk about that because I really felt like as you were going through argument 1 and 2, that in some ways that ESG is a little bit of a window into the future.
Well, a little bit, yeah.
A little bit, because you're talking about future tech, you're talking about industries that are emerging. Like there's a little bit of that lens is putting you into a window into the future to some degree.
It is. To some degree it is. I think it's also just putting that window on, if you're concerned about it, then it's likely that there's a government regulatory agency that is also concerned about it. And, you should just think about like, what are the growth prospects for something where people are actively dumping money into like counter advertising for, right? Like, is it good to invest in a company where on the other side of it, there's a bunch of people investing money to be like, no, you guys shouldn't use this product, right?
Well, I think, it's just exciting to even have this conversation. I think it really speaks to the evolution of thought on Wall Street and the fact that we're talking about this is going to have a big impact on the investment world. It already has. The fund flows have been massive into ESG strategies, and yet it's still just a teeny tiny percentage, less than 5% of total assets.
That's right.
So has ESG gone mainstream?
Oh, I think it's absolutely gone mainstream because I think it gives everyone something new to talk about, to offer, to, and it definitely started on the fringes, right? Like it definitely started on the fringes of like, hey, this is a product that we can potentially offer. And so let's be clear, it's not for everybody, right? Like, there are plenty of clients out there that are just like, look, like I got no problems with tobacco and I don't have a concern about global warming or I don't have a concern about this, that, and the other. And so like, I'm good. I'm just going to invest in the market. If it's legal, it's good. And there's no criticism of those folks. This is just a way to bring, as we talked about before, a way to sort of democratize or bring this notion of, I want to think about more than just absolute return when I invest in these companies. I want to think about like, what are they doing? And how can I do that? How can I, as a busy professional or a busy homemaker or a busy whatever, like I've got other things to do with my time rather than start reading through companies' 10Ks and figuring out like what they're doing in sub-Saharan Africa. Like I don't have time for this, right?
Yeah.
So let's make it so that my investment manager is focused on that stuff for me, that my investment manager understands that these are concerns of mine and is going to tailor my investment portfolio to at least be partially reflective of those concerns. That thought has gone mainstream. And it's definitely something where, if you don't care about it, you absolutely don't care. Right. But when you do, right, then it's definitely something that you are interested in, want to look into, and want to be able to, it helps you better sleep at night.
Yeah. And I've heard you say that, and that was what was, I think, inspiring and interesting about you creating the Steadfast ESG portfolio, it was in direct response to demand for it. It was calls from clients like, this is important to me. I want to, of course, develop my financial plan. I want to be clear on my risk. I want to be clear on my investment objective. I want to be clear on my goals. I want all these things to happen with my money, but I'm equally as focused on wanting to be able to sleep at night and feel like I'm voting with my money. I'm doing good, in the same way I'm really intentional about where I shop or how I conduct myself. I want that to be reflected in my investment portfolio as well.
Absolutely. That's absolutely the case. And, it's been really, we talk about around the office, like, you'll mention it to some clients and it'll be, absolutely like, oh, well, I don't really care about that. That's not, that's not
it's
something
just not on my radar.
It's not on my radar.
Yeah.
And then you'll mention it to somebody just randomly in a coffee shop and they'll be like, oh my God, you can do that. Like, where's the client paperwork? Like, sign me up because I've been talking to my advisor for years about trying to do something like this. And they keep blowing me off. The products are now mainstream enough that if this is a concern of yours and you feel like you're getting blown off, like you should reach out to somebody that can actually offer this to you.
Yeah. Talk to your advisor.
Talk to your advisor.
All right. Anything else that you want to cover?
I'm good. I think that just in summary, this is a way for you to think about a double bottom line sort of impact to your portfolio, right? So I'm building my financial legacy, but I'm also thinking about what my social legacy might look like. If that's something that's interesting to you, then you should reach out to your advisor and have a conversation and start the conversation about whether or not one of these portfolios would be right for you.
I'm going to steal that double bottom line.
Good stuff.
All right. Well, thank you all so much for joining us. We really appreciate your time. We love to talk about investing, the markets, trends in investing like ESG. So if you have any follow-up questions, please reach out to us. You can check out the ESG portfolio on investsteadfast.com or reach out to your financial advisor. Thank you so much. Have a great day.
Are you enjoying this content? Please subscribe to our YouTube channel or follow us at RFG Advisory on Facebook, LinkedIn, and Twitter. Thanks.